Well, welcome everyone. We're so glad that you joined us today. We have a number of people around the country that are logging in to listen to this timely webinar. We also have a group in our Birmingham, Michigan office who are gathering, so I want to welcome you. Excited today to spend time with Jeff Kleintop. Jeff is the Managing Director and Chief Global Investment Strategist at Charles Schwab. Jeff has he's been very busy as of late, and we're privileged to have him with us. Jeff has frequently been cited in a range of national media outlets, including the Wall Street Journal, New York Times, Barron's, Financial Times. He's a regular guest on CNBC, Bloomberg, Fox Business News, and CNN. And he's been cited in the Wall Street Journal as one of Wall Street's best and brightest. And I know that one of the highlights of Jeff's career, his accomplished career, is that he was also a guest on the Day in a Canoe podcast when he and I had a great conversation. So, Jeff, delighted to for you to meet all of us today. For those of you as guests, I'm Nathan Mersereau, President of Planning Alternatives. We're hosting this event, and we want to provide timely insight that cuts through the noise. There's so much in media, conversation about what's going on in the world, and we simply titled our webinar today, "What in the World is Going On?" So, Jeff, I pose that welcome, and I pose that question.
Thanks. Well, thanks, Nathan. You and I go way back, and so it's great to spend time with you, and also, of course, share some insights with everyone out there. There's so much going on. There's a bull market of things to talk about. So, yeah, what in the world is going on? Well, it seems like the market's most focused on tariffs this year, but obviously there's a lot of other things going on as well. But it seems like the focus is on that, and I guess I have to say I worry a little that markets may be getting too enthusiastic that the tariff risk is over or the peak of its past. I think a lesson from the first Trump trade war with China is that after a 90-day tariff truce that began back on December 2nd of 2018, the two sides did not resolve their differences and tariffs increased again until we got that phase one trade deal in January of 2020. So that's a bit of a concern that we basically, in this 90-day window, which we're getting to the halfway point on here, we've only really established a framework with the UK and only agreed to kind of come to the table with China. There's a lot of other countries out there that certainly we need to forge some kind of agreement with, or at least make progress on to extend that 90-day window. It takes about 18 months on average to get a trade agreement signed. So we're not going to get deals signed in this 90-day window, but at least working towards them would be good. I think the fastest trade deal I can remember, Nathan, in recent memory was the one during Trump's first term. It was with Japan. That took 13 months to get signed. So, I think the market's idea that this is all over is maybe a little overdone. One more thing I'd add is that the sector tariffs could come as soon as next week on semiconductors and the related hardware supply chain, along with tariffs on pharmaceuticals. They're now out of their comment periods. That ended May 7th, and we're in this 270-day window where they could be imposed, and the new tariffs could be announced next week. Certainly, I think they'll be announced by the end of June. And those sector tariffs, along with the ones on steel and aluminum and autos, might soon be the bigger ones impacting businesses rather than the country level tariffs. I'll give you a quick example. Korea is a country that we're working on a trade deal with, and the Trump administration said it's going relatively well. But those country level negotiations may not mean anything because of Korea's 128 billion in exports to the US. Over half were goods like semiconductors and auto parts and steel. So those sector tariffs are going to apply more impactfully than the country level. So the uncertainty around tariffs could return, leading to some ups and downs in the market. And that's the number one thing I guess I'm focused on so far this year.
Thank you, Jeff. I'm sharing on screen here a commentary that you, Liz Ann Saunders, Kathy Jones, and Kevin Gordon compiled just a few days ago on Schwab's perspective on tariffs. And it's an excellent article. There's a number of things that we can even highlight in this article. But the thing I'd like you just to simply guide us through, what are tariffs? Because I think simply that term gets applied in many ways and may be understood in one way, but not understood in another.
Sure. So, so I bought a guitar from Japan a couple of years ago, and when it was shipped here, it got to Customs and Border Patrol, and then they sent me a bill for the amount of the import tariff, the customs duty, and so I had to send that to them before they would release. They had to inspect it to make sure it was indeed what was on the invoice, and it was. It was this really cool guitar, and then they once that was paid, it was about a delay of maybe 2 to 3 weeks to get all that done, and then it was sent on to me. So I paid that import tariff, and that's how it works. So the idea is that the U.S. establishes higher costs for things paid for by U.S. importers. And what's interesting is, and with the goal in theory of making imports more expensive from overseas so that it would incentivize more manufacturing within the borders of the U.S. that would be subject to those tariffs, and then they get that advantage of not having to pay that tariff, whatever it is, 10%, 20%, 100% on some Chinese goods. The reality is that is exactly what's happening right now. So there could be a negotiation between the exporter and the importer, right? Maybe the exporter says, "Hey, look, maybe I'll give you a 10% discount because I know you have to pay that new U.S. tariff, and I want you to continue to be my customer." That could happen. It's not happening. So we just last week on the 16th, I think, we got the April U.S. import price data. So what it does is it measures what are we paying for the things that we're importing, and that price went up by the exact amount of the imports. In fact, it's up 22% this year. We saw that in March as well. So 100% of the cost of the tariffs is currently being borne by the importer. There's no discount being applied by the exporter, even though they don't technically have to pay it. They could discount as a result and negotiate it, but they're not. So right now, U.S. importers are paying 100% of those tariffs. And there will likely be a profit margin impact. And that's what we're hearing from Walmart. And that's what we're hearing from Target. And that's what we're hearing from the automakers and many of them that produce overseas and then sell in the US. Ford and GM make a lot of cars in Mexico and Canada and then import them into the US. And so the cost of all of these things are showing up in squeezed margins because they're not sure how much of that they're going to be able to pass on to the consumer. Even though inflation is expected to rise here as a consequence of this, profit margins are also expected to come down a little bit. So that's what tariffs are. The reason they're put in place is to incentivize U.S. manufacturing. The challenge that they pose, of course, is that in the near term, it's very hard to suddenly find workers, materials, and factories in the U.S. that can produce a lot of these things. So in the near term, it's a bit of a crunch, and that's why we see these sort of almost pandemic-like concerns about shortages and inflation. Simply because in the near term, and the near term being a year or two, it's very difficult to recreate those supplies.
I'd like to share a slide from JP Morgan. Sorry, it's not a Schwab slide, Jeff, but it's a resource that we use often in terms of sharing information with our clients. And it simply goes back in time to the average tariff rate on US goods imported for consumption. So what's happened is that this topic of tariffs have just taken center stage, but this is not a new concept. This is not, we've had higher tariffs in periods of our history before, and you can see from this chart, it goes back all the way to 1900s. It's just if you look over the last 20 to 30 to 40 years, specifically 1980 on, there's been a significant decline in the lower right in the chart of the amount of tariff that has been applied. And so it's really the increase, as you can see in the arrow here on the far right, in terms of maximum export to tariffs, is a shock to the system. We've been accustomed to these lower tariffs, and there's a shock. How, Jeff, would you suggest? What are the scenarios that could play out as we kind of process through this on the tariff side?
Well, I see three scenarios. Number one is that tariffs simply remain in place, and they're brought back after the end of this 90-day expiration on July 9th, and they are a key element of the president's agenda, supported by the majority in Congress. And so we get tariffs at these levels we haven't seen since the Great Depression. Of course, in the Great Depression, they were a contributor to the slowdown in economic growth. Back when the US was an emerging market, many emerging markets have high tariffs. We've removed those as we've become a dominant economy. Reversing that would cause a lot of dislocations, as I mentioned, in terms of supplies, inflation, shortages. In the near term, it would certainly be a hit to U.S. economic growth. Um, that's one scenario, and it would be a relatively negative scenario for the stock market. Hard to avoid a recession in that scenario. More in the U.S. than elsewhere around the world because the U.S. is in essentially a trade war with everyone. Everyone else in the world is just in a trade war with the U.S. For example, Europe only about 3% of Europe's exports are to the U.S. So it would impact their economy, but not dramatically relative to the U.S. The second scenario is we cut deals, and there's some reason to believe that could happen. I already mentioned how long it could take to cut those deals, but given that the Trump administration has relented on some of its demands to bring China to the table, we could potentially see some deals there. Something with the EU. The EU made some proposals yesterday that some of which are aligned with the U.S. administration's goals, so it's possible. Japan might be a pretty easy deal. The UK deal is very easy because we have a trade surplus with the UK. There's the USMCA agreement. Those are our biggest trading partners, Canada and Mexico. We're working on all of that, so it's possible we get some deals. Tariffs go up from where they started this year at about 2.5%. Maybe they go to 10%. But they don't go to, what you showed in the chart there, 26% or higher, which would be recession inducing. So I think we can manage without a recession an increase in tariffs to 7, 8, 9, 10%. And that'll be another scenario. The third scenario, which may be more likely than the other two, is some combination of those and a lot of tariff avoidance. There's two ways to simply avoid tariffs if you're an exporter to the US or an importer in the US. One is by transshipping, simply buying things from China, only having them sent through a third-party country first. The goods we're getting from Vietnam, Cambodia, and Thailand have surged over the last few years, really since the Trump tariffs were put in place back in 2019. China's exports to Vietnam, Cambodia, and Thailand have soared by the exact same amount. So we're still getting the same amount of things from China. It's just passing through another country on the way, avoiding the steeper Chinese tariffs. That's increasing at a large rate. I would say about 20% of US imports are passing through another country to simply get a lower tariff rate on their way to the US. Again, that could widen. The second way of doing it is by under invoicing. And that's meaning whatever the exporter puts in one of those container units on a ship in China, when it gets to the US, the invoice is going to have a much lower value on that. Meaning a lot of the things in that container are going to be under invoiced at a price below what they actually are, or they're just not going to account for everything in that container. This is common. This has been going on for a long time now, really since the first Trump trade war. I would say that based on the value of exports from China, so we track the amount exported from China to the U.S. and the amount imported in the U.S. from China. And there's currently over $100 billion difference in those two estimates. There's a lot of under invoicing going on. I'd say about 25% of the value of what's in the container is not invoiced properly. Now, you might say, well, wait, isn't that what we inspect at the ports? Wouldn't those people get caught? Let me take a second and go on this tangent. By my estimates, there are a little over 1,000 Customs and Border Patrol import specialists at U.S. ports. There's 70 ports in the U.S. The ports of Los Angeles and Long Beach by themselves processed about 105,000 containers this week. And that means that the customs specialists there are responsible for inspecting about 50 containers a day. That means they X-ray them, and if there's anything different in that X-ray versus what's on the manifest, they have to unload the whole thing, catalog it all, reassess it. That can take hours, 3 to 4 hours. Well, there's only 8 hours in a day, so those 50 containers, many of them are just going to get by. It seems to me the CPB is dramatically under-resourced to evaluate every incoming shipment to avoid further widespread under-invoicing for tariff avoidance. And so with the incentives to avoid these tariffs so high, right now tariffs on China around 39%, but they could bounce back to 100%. So the import data, I think, has become less reliable, and a significant percentage of China's exports to the U.S., 40 to 50%, if you count transshipping and under invoicing together, face a much lower effective tariff rate. So I think that third scenario is probably more likely. Some countries we cut deals with, some we don't. but companies find a way around some of those big tariffs. And therefore, the impact on inflation, the impact on the US economy, the US and US profit margins may be less than the theoretical impacts if we just look at where tariffs are on a statutory basis. Sorry, long tangent there, but I think that reality is important because there's a lot of theory talked about with tariffs.
That's great insight. That's illuminating that there's a lot of gaps in the system. There's a lot of empty space. I want to invite and encourage everyone attending to submit questions as we go through our presentation today. And we invite you to just share what's on your mind, and we'll try to weave that into the conversation. We actually received a question on the topic of tariffs. Just for clarity of explanation, are sector tariffs and country tariffs the same, or how do they integrate? When we hear there's a sector tariff or there's a country tariff, is that all one and the same, or those separate items?
It's a great question. They are separate items and they can stack or they can be independent. So, what we saw in the Liberation Day tariff announcement, a lot of tariffs on a lot of different countries, right? Even those populated by penguins. But what we saw excluded from the tariffs at a country level were semiconductors and pharmaceuticals, not included. Basically saying whatever you get from these countries, this level of a tariff is applied, 10% or what have you, except on those exports of semiconductors and pharmaceuticals, because those will be there will be a rate set on those later that applies to all countries. So, we've seen that some countries may get specific and unique sector tariffs applied just to them. I think Europe is attempting to negotiate auto tariffs that are unique just to Europe. Don't apply to Canada, don't apply to Mexico, don't apply to Japan, don't apply to Korea. So we may get a complex level of country level tariffs to apply to most goods, sector level tariffs that apply to all goods of that type coming into the US, and then another category where, well, it's applied to pharmaceuticals, but only pharmaceuticals from Ireland. So the complexity is amazing. In fact, we went through and we looked at the product codes and the country codes and kind of came up with, you could have what now is about maybe there's about 3,000 different product codes in terms of things coming in that apply to different countries. You can have over 3 million. I mean, it'd be very complex for Customs and Border Patrol. What's this? What is this product? Okay, what applies to it? What country is it coming from? What's the country level? And then there's all kinds of shenanigans about classifying something. I'll give you another quick example. There are these really popular belt bags right now. So it's like a handbag, but it's attached to a belt. People wear them over their shoulders or around their waist. We used to call them fanny packs, not a cool thing anymore. They're belt bags. So there's a big question. Well, are they belts or are they handbags? Two different levels of tariffs apply to those products, depending on what country they're from. So there's all kinds of lawyering going on in terms of getting things qualified at the lower rate rather than the higher rate. No, it's a belt. It's really a belt. It's not a handbag at all. That kind of thing is going to go on ad nauseum as we get into the complexity of all of these things. So they are two different things. Sometimes they can stack. They've been so far set separately, but the shenanigans around what qualifies for what is going to be a free for all for the lawyers, I'm afraid.
Now, I would be remiss if I didn't share my Canadian passport here, as I am Canadian and a US citizen as well. After a debate around Canada becoming the 51st state and all the things that are going on with what happened with the election in Canada, given the Canada-Mexico connection, what has played out? Like, what's the real-time update with negotiations with Canada and Mexico, and how the tariff story evolves through those countries?
So Canada just had an election, and so things were kind of on hold until Mark Carney won that election. So that was, just 2 weeks ago, a little less than 2 weeks ago. So I think things were a little bit on pause because we weren't sure whether it was Pierre Poilievre or Mark Carney that were going to be running the government there, conservatives versus liberals. The Liberal Party won, and so now those discussions can push forward. The challenge there is that Carney is very opposed to the Trump administration. They're sort of at loggerheads here. So it'd be interesting to see. We've got a G7 finance ministers meeting in Canada this week. We'll see how that goes. It's wrapping up today. Probably not a lot of progress there. On Mexico, looks like Claudia Sheinbaum, Mexico's president, has been effectively working behind the scenes to kind of work on a relationship between Mexico and the U.S. But not a lot has been published. So, I follow them on social media. I follow State Department people in both places to try and find out what's going on. Not a lot has leaked out. I think that that's a longer term negotiation. So the USMCA is subject to a 6-year review, and that will be up well, almost exactly a year from today. So that will be something that I think is going to linger. I think we're going to move through bits and pieces of that relationship over the next year. So I think we'll probably freeze in place a lot of the tariffs that we have now and some of the exemptions and kind of work towards something. It means the uncertainty is not going to go away anytime soon. Now that's a big problem for US automakers because, of course, Ford and GM are actually the biggest exporters from Mexico to the US and Canada to the US. Believe it or not, they're not Mexican or Canadian companies, they're US companies with operations over there. In fact, if you take a look at the biggest names in Canada, it's a lot of banks. They don't do any exporting to the US. If you look at the biggest stocks in Mexico, it's Mexico's Walmart, it's Mexico's telecommunications company, it's Mexico's Coca-Cola bottler. They don't do any exporting to the US. They only serve the local markets. So they're not subject to tariffs. It's the US listed stocks headquartered in the US that operate out of those countries that assemble there and then ship to the US that are really negatively impacted here. So the negotiations around this stuff are happening between businesses, US businesses, and in Washington, D.C., and with the administration, much more so than I think Canadian or Mexican officials are negotiating with the U.S., since it's the U.S. businesses that are more impacted. So interesting, tangents to all of this and why I think it could take some time for that to resolve itself.
Now, what's been so interesting year to date is the performance of the international market compared to the US market. And in fact, in the article that you put together with your team, you highlight how emerging market, has really advanced this year. What are some of the drivers behind that, and where does the US currency, the value of the dollar, contribute and fall into those performance numbers?
Yeah, international stocks have done incredibly well this year, and developed market stocks have done the best, particularly in Europe. But emerging markets have been interesting this year because I think if you think, late last year after Trump's win, investors were totally focused on, America First policies and fully expected. And in fact, between Election Day and the end of last year, the US stock market performed the best, followed by developed international stocks, followed by emerging markets, followed by China, which was down a lot, right? So the markets were positioning for, wow, this is really bad for China, really bad for emerging markets, probably bad for developed markets, but good for the US. And the exact opposite has unfolded this year. We've seen really strong performance outside the US, including in China. China's stocks are up like 18% this year. And one of the reasons is that China's economy is 40 to 50% driven by consumer spending. And only 3.5%, around 3% actually, of China's exports are directly to the US. Now, remember, I said there's a lot of transshipping. So it's probably 3, 4, 5, another 3 or 4, 5% that are going through other countries on the way to the US. But even if you add all that up, fine. Maybe it's as high as 7 or 8% of China's economy is exports to the US. 40 to 50% is consumer spending. And it has been absolutely in the doldrums for a couple of years now, in part because the property market in China has been very poor, a lot of other problems. That's being addressed this year. China, for the first time in a couple of years, is really stepping up in stimulating consumer spending. China has 3 different budgets. And if you combine them, we're looking at about 11% deficit spending this year in China, a record, more than they spent during the pandemic, more than they spent following the great financial crisis. This is an enormous amount of money directed towards turning around domestic demand in China. If you can see a 5%, a 10% boost in domestic demand off of recessionary levels, that more than makes up for any of the slowdown in sales to the US. And so that's helping to drive China. Broad emerging markets are doing well this year. Currency is helping as well, right? So the dollar's down a lot this year, and that generally a weaker dollar is good news for international markets and particularly good news for emerging markets. So a lot of factors are combining better economic momentum, domestic economic momentum, earnings momentum, much cheaper valuations. You're looking at below average valuations in emerging markets coming off of those lows. All this coming together along with the currency situation to really help promote international markets. So emerging market doing really well. In 2017, the first year of Trump's term, which was that chart that you referenced, we saw emerging market stocks outperform US stocks every single quarter that year, contrary to what a lot of folks thought would happen. And that was because China invoked a lot of stimulus in 2017 and their economy turned around and global growth did okay despite the fears of tariffs, despite the fears of all the uncertainty. Same thing seems to be echoing through this year through the emerging markets. They're doing really well. Developed markets are outperforming emerging markets this year, but they're still performing quite strongly.
Now, with the US currency lowering, what is it that drives the valuation of currency, US currency relative to others? I mean, it's a high level question, but there's so many things that are in play. What should clients have or contacts have that is on their dashboard to say, I just want to be in tune with this? Is it US versus the Eurozone? Is it the US versus Japan? How do we navigate this currency conundrum?
So I've been doing this for 30 years, and I'll let you know when I figure it out. It is currencies are the hardest thing to try and understand what drives them. There are several factors that should drive them, and sometimes do. Typically, it's a differential in interest rates, right? So a currency is more attractive based on how much that cash yields. What are the cash yields, right? So in the US, generally cash yields, short-term interest rates have traditionally been a little bit higher than cash yields in the rest of the world. And so that's made the dollar more attractive over the last 10, 15 years. And so you want to hold your cash in the currency that pays the highest cash yield. That's part of it. The other part is, well, what country is experiencing the most inflation relative to others? And if inflation spikes in one country, it means the value of its currency really isn't what it seems because inflation is eroding the value of that currency. So if inflation, for example, in the US is higher or deemed to be higher going forward than elsewhere, well, that's going to undermine the value of that yield. You're just going to erode it in inflation. So your real return isn't going to be there. So relative inflation is also a factor. Then there's the credit worthiness of the country, right? And so, of course, we know Moody's just downgraded the U.S. following Fitch, following S&P over the years, downgrading the U.S.'s credit profile, concerns about spiraling deficits and a lack of any fiscal stability, and a lot of concerns about political instability as well. And so all those things can factor into the desirability of holding a currency. If I'm a Chinese national, or let's say I live in Saudi Arabia or some other part of the world, and I've been holding treasuries, am I worried that the Trump administration might suddenly expropriate my assets like they did with Russia? That I might not get my money back on those treasuries. Maybe I'd be safer putting it in gold, or maybe I'd be safer putting it in Japanese bonds or some other. So there's been a flight of money out of the U.S. Even though interest rates have been rising around the world this year, only the U.S. has seen its currency go down at the same time. That's suggesting money coming out of U.S. markets, bonds and stocks, into international markets. And that's lately what's been the driver of the dollar this year. And that's why the dollar's down 9% against the euro, 9% against the yen. It's really money moving on a structural basis out of the U.S. to other parts of the world.
How do we look into the future with expectations around a recession? And that's always been a topic that's kind of overshadowing and related to the tariff topic. What's your viewpoint on what's ahead around recessionary pressures?
So I think if the tariffs come back in full effect after July 9th, the concerns about recession will emerge again. It's very hard, the longer those level of tariffs are put in place, for the US to avoid a recession. Remember, this is a supply shock to the US, like the pandemic was, not a demand shock. Other countries may be experiencing a demand shock, meaning demand from the US might fall. Europe, for example, about 3% of its exports are to the US. A 20% tariff reimposed on Europe goes back up from 10 to 20, let's say, after July 9th. That might shave 0.6% off of Europe's GDP. So it's a risk, but it's not enough to prompt a recession. In the US, could be much more dramatic than that because it's a supply shock. Very difficult, as I mentioned earlier, to recreate factories, find workers, source supplies in the near term in order to offset the this potential impact on shortages. And we know the impact that that can have, having gone through the pandemic not that long ago. And look, I'm not seeing a big ramp up in U.S. manufacturing to prepare for this either. Looking around the world, uh, um, we are not seeing a big surge in domestic manufacturing. Look, when we talk about jobs moving to the U.S., many of these were low-cost jobs. The Commerce Secretary Letnick talked about, screwing in iPhone screws or making dolls here. Those low-cost labor jobs will be done by automation in the U.S. Now, I'm in Florida. We just had the Miami F1 event a couple of weeks ago, and people may be familiar with Haas Automation because it has an F1 team. Haas is one of the US's biggest providers of computer controlled manufacturing equipment. If anyone would know, if the US is investing to bring this manufacturing back to the US, it would likely be them. But earlier this month, they reported what they termed a dramatic decrease in demand as a result of the trade tariffs and noted that they'd reduced production, they'd eliminated overtime, they'd halted hiring while they were studying the impact of the tariffs on their operations. So if it if it's an option, it doesn't seem that anyone's working on it yet. And I'd also point out quickly here, TSMC, right, the world's biggest and best chip maker. They make those chips for NVIDIA that are so popular, right? They would love to be able to manufacture here in the US, and they're trying to, but there's a reason they haven't done it so far. The recent news that TSMC's Arizona chip fabrication plant is delivering higher production yields than the ones back in Taiwan appears to be good news. But if you dig beneath the surface, TSMC's high yields were achieved in really small scale trials, probably not replicatable in full scale production. And even if they were, they're unlikely to offset those higher construction costs. Let me give you an example. The three U.S. plants that TSMC is going to build in the U.S. Cost $65 billion. That's the estimate. Could overshoot that. $65 billion. At the same time, TSMC is also planning to build three plants in Taiwan. The cost? $9 billion. So if you compare that, that's 700% more expensive to operate in the US. And those trial yields were only 4% better than in Taiwan. So TSMC is an example of what other companies and sectors are similarly going through as they consider the expensive and challenging options to manufacture in the US. So this supply shock, the longer that tariff hit goes on over the next year or two, would seem to push the odds of recession in the US to over 50%, but probably still keep them slightly under 50% for most of the US's trading partners.
Now, a topic to add more to the mix, but wait, there's more, is the U.S. deficit. And this is a busy chart, but if you look at the lower right-hand side where it shows federal net debt as a percentage of GDP, the line back to 1940 spiked up and then went down in the 70s and 80s, but has steadily increased as you look to the right, which is the percentage of our GDP that's truly caught up in our net debt. So we are, and this is a story that we've talked about before in previous webinars. It's something that I'm personally concerned about. I know many people in the investment industry as well, planning alternatives team is focused on this, and it's not something that we're trying to say everything is in crisis right now, because these things take a long time to play out. But our level of debt and the financing of that debt is simply unsustainable. And we've got a tax bill that was got through the House, I believe it was last night, the big beautiful tax bill that is not talking about cutting expenses. It's about keeping taxes lower and basically amplifying the whole issue with the debt. How does our U.S. debt issue play into the story? And I know that's a big question, but it's something that's on a lot of our clients' minds.
Sure. Well, it's certainly one of the reasons why yields have been pushing higher here. The 10-year yield is pushing back to some of the highs we last saw in 2023, and could go through them. I mean, the idea that we are going to be issuing more and more and more debt and requiring the rest of the world to put more and more of their money into treasuries in order to finance it at a time when we're telling the rest of the world We don't want their goods. We don't want their products. So it's an increasing challenge, right? When we're expanding our trade with other countries, giving them more dollars because we're buying their goods, they can recycle those dollars and put them back into more and more treasuries. But when we're telling them we don't want your stuff anymore, we're not going to give you those dollars. Where are they going to get the money to put into treasuries? And so that's the increasing problem and why it's pushing up interest rates. In Europe, just by contrast, over the last 15 years or so, their debt to GDP has not gone up at all. It's been very stable. It might start to rise in the years ahead as they spend more on their own defense and other factors, but it's a big difference. They're spending probably 2% of their budgets on interest costs. We're spending about 4% of our budget on interest costs, and that's of GDP, I should say, an interest cost, and that's rising every year as we look out into the future. Could become an increasing impediment going forward. Another one of the reasons why we're seeing the dollar go down as well. There are two ways in which you can entice foreigners to finance your debt. One is to pay higher interest rates. The other way is to give them a discount by essentially discounting the price of the bonds in dollars relative to their domestic currency. So that's what's happening right now. If you're investing in treasuries this year from overseas, the dollar's gone down and down and down, and that's just meant basically you're getting a discount on buying that essentially on that yield. So that's a lot of what's happening long term. When we take a look around the world. There aren't a lot of examples of large developed countries that have run into major debt problems. When they do, it's usually the currency that gives way and not the interest rate. We've seen that in Japan. We saw that in Italy. We saw that in Greece. Their yields went up as well, but we saw their currencies really tumble. And so the fact that we're finally seeing a breakdown in the dollar here this year by 9 or 10% is finally a worrisome signal that maybe we're finally getting to a point where we're pushing, maybe not too far, but maybe too quickly in terms of the amount of debt that we're looking to increase and the rapid pace at which we're increasing the deficit.
A number of people have been shocked by some of the gyrations in the U.S. stock market this year. So this chart is looking at the S&P 500, 500 of the largest stocks in the U.S., and it goes back to 1980. And you can see at the bottom of the chart the years and 5-year increments. And it illustrates every year, every calendar year, that bar chart will be positive or negative each year because that simply represents the annual return in that year of the S&P 500. So you can see that over time, and we've been through a lot as a country, in the world, certainly since 1980, that 34 out of the 45-year period in the S&P 500 has been positive. This chart was through the end of April, which over here on the right, it ended down 5% and has rebounded significantly since. But the red dots on this chart are the low points of the year, the intra-year lows within the S&P 500. And 100% of the years, there are red dots. And having volatility in a financial strategy is to be expected. That is part and parcel of what we have to navigate as we go through various economic cycles. And one of the things that we are rooted in completely is diversification, that principle of diversification. That's how we navigate risk in an uncertain environment. And it also means that we need to take time and allow time to run its course. When you have money that you need in the short term, that should be very conservative. The intermediate term, maybe a mix of, a little aggressive, little conservative mix. Longer term, you can afford to be aggressive. What we're going through right now is turbulence, and we expect continued turbulence. We don't want to be naive. This is just not a one moment in time. This is the nature of investing. So we want to encourage everyone to have perspective about what long-term investing success means, but we want to be fully aware of what's going on in the moment and be aware of how to navigate the challenges and turbulence that we face right now. Jeff, we're coming to the end of our session here. And any commentary from a diversification or strategy approach?
Yeah, I mean, what you said is great, and I want to reiterate this idea of like with all those red dots. Man, every one of those red dots was just a real stress, a period for people like me and people like you, so many people, right? But the hardest thing about selling is not selling; it's the getting back in. And this year's been such a great example of that, right? The markets fall sharply. it was what, April 8th, 6 days after April 2nd, Liberation Day, that markets bottomed and rebounded nearly fully. So, really, it's so hard to get back in it. That's the harder decision. And so, I think accepting that there's going to be some volatility, accepting that you need some diversification in your portfolio to ride out those ups and downs, far better than trying to say, well, I'll just wait till the coast is clear when I come back in, because we all know when the coast is clear, stocks are going to be a lot higher. Market watchers tend to define market cycles by bull markets, this period between bear markets, right? Those 20% declines we call bear markets. The current bull market we're in began in mid-October of 2022. And since then, international stocks have been outperforming US stocks, providing real diversification for the first time in well, many, many years, a full decade prior to that. That's the opposite, right, of what happened from the great financial crisis to like 2022. US stocks were the only place to be. The outperformance has been dramatic. European stocks, for example, which make up more than half of the developed markets outside the US, have outperformed the S&P 500 by more than 35 percentage points since that bear market low, since this bull market began back in October of 2022. And I think that's been off the radar of many investors that have just focused on US performance or the Mag 7 growth stocks. Leadership has really shifted to financials, to industrials, to value parts of the market, offering more value from diversification. In Europe, earnings are coming in the best relative to expectations in years here in the first quarter that earnings were just reported for. I continue to favor rising economic and earnings growth, a combination of fiscal and monetary stimulus. They haven't seen that in 15 years. Regulatory reforms, as right-leaning governments that were elected last year begin to impact policy with defense spending and a lot of other initiatives. Return to nuclear power in Germany, for example, along with very attractive valuations. Valuations are below their 10-year average in Europe. Certainly not true in the US. There's relative political stability and a rising euro. All that points to the benefits of diversification right now and helping that buffer some of the volatility. This year, European stocks are up over 20%, really helping to offset, sort of the flat returns here in the US stock market. I think that's the key here in managing this volatility rather than trying to jump in or out of the market.
Jeff, your internet may be subject to tariffs because your audio is a little spotty, but we got the essence of your message. Thank you.
Oh, sorry.
I want to share a chart that is familiar to many, and that we call this the diversification quilt, and this is from the JP Morgan slide deck. But it shows since 2010, as you can see in the top, year by year, each color box represents a category of investment. And so the colors will bounce around year by year. They're in rank order from highest to lowest in the column each year. But that light white box, that light gray box called asset allocation with the dots on it and the lines connecting it, that's what we're doing for our clients. We're navigating this wide range of outcomes to create more predictability by hugging, we call it hugging the middle. We're not trying to be extremely high or extremely low. We've built your financial plan. We know what is needed to achieve your goals. We want your asset allocation to be on target based upon the risk level that makes sense for you and that you're comfortable with. And this is an example of how we navigate through uncertainty. So just sharing this as a good reminder for all of us that diversification matters, especially in this time. Jeff, we have speed round. If you've got more than 60 seconds, I'm going to hit you with a few questions that have come in. First one is on AI. How do you think the United States is positioned to benefit economically from AI?
Well, the US is positioned really well to benefit from AI. We have a tight labor market in the US, and so we need to find ways of improving the productivity of our workers rather than trying to put more people to work, because it's very difficult to get below a 3% unemployment rate, and we're at 4% now. I would argue that 3% of Americans are simply unemployable, evidence would suggest. So we're very close to full employment. How do we get more out of everybody? More productivity. And I think AI should deliver that. So rather than looking at the hardware side of AI, where investors have been focused for a long time, I think the real benefits will accrue to, or more likely to accrue to, the users of it in healthcare, in financial services, in a lot of areas where a lot of data is required, and a lot of quick processing time can really be beneficial. And I think that's where we're starting to see a lot of investments. We haven't seen as much as I would have thought, based on the number of CEOs talking about using AI versus what they're actually spending. When we take a look at the categories of capital investment into information and software and servers and that type of thing, still fairly low. But I think they're still sort of feeling out where those advantages are, and they're trying to figure out what the right solution is for them. But tremendous potential for a better diagnosis in the healthcare world, better solutions on in terms of just finding answers to questions and parsing data. Just really incredible what it can do. I think there's a lot of focus on the entertainment side and who's got rights to what and what is the intellectual property. And I think that's a sidetrack from what really matters, which is just getting the right answers to the problems that we deal with every day, finding quicker solutions, better customer service, more effective mass customization of products and information and answers than sort of just mass market. And I think that's where we're going. So I would look to those big sectors like financials, like healthcare, where they really haven't seen any of the AI interest lately. Those might be the areas that benefit longer term. Like with the internet, sure, early on, it was all about what internet company is going to do the best or what hardware solution, what routers. But it ultimately became the retailers that really were the big winners in terms of their profit margins from the internet. I think the same thing could unfold from AI here. How much? Hard to say. Again, we haven't seen a tremendous amount of investment. Usually we see a surge in investment. 2 or 3 years later, we start to see the productivity payoff. We haven't seen a big investment yet. Yeah, I know there's a lot of chips on order. Yeah, I know there's a lot of stuff being made. But in terms of actual investment by a lot of these businesses, it's still on the lower side from what I'd expect relative to, let's say, the internet wave or, when we took a look at GPS and what that meant for the automakers and or going back even further to other new waves of technology, just not quite the same level of investment yet. So maybe the productivity payoff is just a little bit further into the future.
We've come to the end of our session today, Jeff. I want to thank you for your time. I'll ask, just as we wrap up, for final comments and insight and that you would share with our audience is what do we do going forward, given what is going on in the world. But before we do that, I want to thank everyone for attending. Sorry if we didn't get to all of the questions. Thank you for your interest. We're here as your financial advisors to navigate through all this turbulence. Please meet with your advisor, your advisory team. We're here for you. And it's more important than ever to remain grounded in strategy, but also remain connected to one another so that we're working together for your interest. Jeff, final comments, please.
That's easy. I just reiterate that. Ask questions and engage. This is a period where there's a high level of emotion tied to what's going on, and a lot of partisanship and a lot of concerns about the future of America and the future of the market. And it's really good. It's totally normal and honest to have those kind of feelings, but to talk about them and what it means to your investments. And generally, for most of my career, I've been able to say, markets and the economy have more of an impact on politics than politics do in the markets and economy. That's become a little bit more balanced this year, to be honest. But it's the other way around. There's a reason why the tariffs were put on delay. The bond market kind of forced the Trump administration to do that. So the markets and the economy are still, I think, having an impact. The bond market deciding political out. There are good things to talk about in all of this and reasons to believe we'll emerge from all of this in a better way. And so having those discussions, talking about these concerns, how to think about it in a broader context and what to do in a portfolio to be sure it's adequately prepared for the volatility is what it's all about. So that engagement that Nathan just talked about, I think, is the number one thing.
Thank you, Jeff, for your insight. Really appreciate you giving us clear guidance and perspective as we work through this together, and appreciate the partnership that you provided to planning alternatives throughout the years. Thank you, everyone. Wish you a great rest of the day and look forward to
My
chatting
pleasure. Thanks for having me.
Bye-bye.